and welcome to another roller coaster ride as we get through COVID. Cathy Sabater, mortgage planner and proud belly. What goes up must come down, or must it? So let's talk about it because everybody keeps saying it's a housing bubble. What do you define a housing bubble to be? Well, I looked it up and it says it is a run-up of housing prices fueled by demand, speculation, and exuberant spending to the point of collapse. So do you think we're in one? Do you? Why or why not? My personal opinion is not yet. Why? Because we have higher lender standards. Our housing finance marketplace, right, is now much robust. Why? And it's safer because 15 years ago, anybody who wanted to get a mortgage. That's not the case now because banks are now having more regulations and they're stricter on what's going on, especially with everything going on with bid over asking, right? Properties going for X, people are paying over what it is actually valued for. So therefore they have a lot more bandwidth, right? And probably are more qualified buyers. And hence, one of the reasons why we're probably not in a housing bubble yet. Let's talk about mortgage forbearance. So did you know as of March 2021, 2.6 million homeowners were in forbearance plans, right? And as the pandemic economically slowly recovered, many people, right, these families resumed their employment and making their house payment. So according to CoreLogic, by the end of 2020, overall mortgages delinquencies declined, believe it or not, due to the forbearance, right? Because the purpose of the forbearance was to say, hey, this is something that we didn't expect, right? So if you lost your job, can't make your payment, we're going to allow you not to make your mortgage payment and not foreclose on your house. That's what forbearance is. So the share of mortgages that are 60 to 90 days, that also declined compared to December 2019, right? So when you're looking at it, remember what the bubble was before. There was what? There was not enough home equity. In this case, we have, since then, stability and growth. And believe it or not, most families have gained at least 5 to 10%. And I'm being conservative because right now equity is double digits, okay? So for example, if you had a $300,000 loan or purchase price, you could potentially, with 5 to 10%, have earned $15,000 to $30,000 in equity, building wealth with real estate in 1 year. How many people can earnestly say, hey, I can save $15,000 to $30,000 a year? Some people, that is what they earn working. So imagine that is building equity. So multiply that by 2 years. So that's $30,000 to $60,000. Let's do one more, right? 45 to 90,000. So that means that same house potentially in 3 years could have $45,000 to $90,000 of equity growth, which means if you sit and wait, it's going to cost you that much more money to get that same house. So let's talk about what happened with the mortgage-backed securities. Well, the Fed's minutes came out and what happened? We lost 20 basis points based on that. And usually that's the case when they speak, because one of the biggest things that the marketplace, as you can see, S&P is also down, 10-year treasury is up a little, and it's all about inflation, right? Is it going to be transitory? Is it going to be permanent? And most importantly, remember the Feds are buying these mortgage-backed securities to keep their rate lower, right? So as we can see here, look at this, right? Here goes the roller coaster ride. Here goes where we see these hammerheads. Now, this is going down here. So we have, again, back to the 25 and 50-day moving average. So we have room to go down just a little, but hopefully we can get some gains moving forward, okay? Stay safe, and I'll talk to you soon.